December 2008, a Manhattan apartment. One of the most respected men in American finance sits his two grown sons down and tells them the truth. The business that made him a legend, the one the whole establishment trusted, is, in his own words, one big lie. For years, the accounts he managed had reported steady, beautiful profits. In booming markets and crashing ones alike, $64.8 billion of wealth printed on client statements. None of it was real. There were no investments. For decades, across tens of thousands of statements, not a single share was ever actually bought. It was numbers on paper, a fortune that existed only as ink. And here is the part that should keep you up at night. A man had handed the government this exact fraud in writing years before it collapsed. He did the math. He begged them to look. Nobody looked. This is the largest Ponzi scheme in history. How do you fake a fortune for 30 years with the whole world watching? To understand the biggest fraud in history, you have to understand that its architect wasn't some fringe hustler. For a time, he was the establishment itself. Bernard Madoff, Bernie, born in Queens, New York in 1938. In 1960, at 22, he founded a small brokerage with a few $1,000s he'd saved lifeguarding and installing sprinklers. Bernard Madoff Investment Securities. And here's the thing people forget. For years, the real business was real. Madoff was a genuine pioneer. He was an early champion of trading stocks by computer instead of by shouting across a floor. And the electronic market he helped build became the NASDAQ. In 1990, and again after, Bernie Madoff served as chairman of the NASDAQ. Chairman, the man who would run the largest Ponzi in history, sat for a time at the very top of the American stock market. His firm made real money as a market maker, matching buyers and sellers, handling a serious slice of the daily trading on Wall Street. He advised regulators. He gave to charities. He sat on the boards. When Bernie Madoff talked about how markets worked, people in Washington took notes. So when he quietly let it be known that he also ran a private investment operation on the side, one that delivered smooth, dependable returns year after year, nobody thought to ask the obvious questions. Why would they? You don't audit the man who helped write the rules. That trust was the first thing he stole. Now here's the psychology that made it work, and it's the exact opposite of what you'd expect from a con man. Bernie Madoff did not chase investors, he turned them away. Getting money into Madoff's fund was treated like getting into an exclusive club. He didn't advertise, he didn't cold call. Access came through the right country club, the right charity gala, the right introduction whispered on a golf course. And when a wealthy investor finally got in, Madoff would sometimes act as though he were doing them the favor, hinting the fund was full, that he might not have room, that they were lucky he'd made an exception. Think about what that does to a person. The moment something feels scarce and secret, we stop scrutinizing it and start feeling grateful just to be allowed near it. Madoff's investors didn't demand answers from him. They were relieved he took their call. And when they did ask how he did it, how he delivered 10, 12% a year, like clockwork, in good markets and bad, he had a story ready. He called it the split strike conversion: buy a basket of big blue chip stocks, then buy insurance against them falling, and sell off some of the upside to help pay for that insurance. A careful hedge strategy that would earn steadily and never swing wildly. Boring, sophisticated, believable. Most investors couldn't quite follow the details, worse, and that was the point. It sounded complex enough to be genius and safe enough to sleep on. There was only one flaw in the split strike conversion. Madoff never actually did it, because the proof was right there on the statements, and the proof was the very thing that should have given it all away. Every month, Madoff's investors opened their account statements and saw the same beautiful pattern. Up a little, up a little, up a little. Roughly 1% a month, almost without fail. When the market soared, Madoff was up. When the market crashed, Madoff was still up or barely dented. Put that on a chart and it doesn't look like investing. It looks like a savings account that pays far too much. A straight line, climbing gently through every storm the market ever threw at it. And that is precisely what real returns never look like. Real markets are violent and jagged. They lurch. They plunge. Anyone who has ever owned a stock knows the feeling in their stomach. Madoff's line had no stomach drops. For something like 96% of the months, over more than a decade and a half, his flagship feeder fund reported a gain. To an ordinary investor, that smoothness felt like safety. To anyone who understood the mathematics, that smoothness was impossible. A coin that comes up heads 96 times out of 100 forever. But by now, the money wasn't arriving one wealthy family at a time. It came through feeder funds, firms whose whole business was gathering billions of other people's dollars and pouring them into Madoff for a fee. Charities, university endowments, European banks, pension money, ordinary retirees. All of it funneled toward one man on the strength of one impossibly smooth line. Everybody was in. Nobody had checked the trades. So let's build the machine, step by step. And I promise, by the end of this, you'll understand exactly how a lie this size stays standing for decades. A Ponzi scheme is the simplest fraud there is. It's almost insultingly simple. Step 1, you take money from a new investor and you promise them a handsome return. Step 2, you don't invest it, you just keep it. Step 3, when that investor asks for their profits or wants their money back, you pay them. Not from any investment. You pay them with the cash coming in from newer investors. That's it. That's the whole engine. Old investors are paid with new investors' money, and everyone's statement shows a balance that's really just a number you typed. And as long as more money is flowing in than flowing out, the machine breathes. New deposits cover the withdrawals. The fake profits look real, because when someone does cash out, they actually get paid. And every satisfied investor becomes a walking advertisement who recruits the next one. Happy clients are the fuel. But look at the trap built into the design. The scheme can never stop growing. Every fake profit you promise becomes a real debt you'll eventually have to pay in cash. So the hole underneath doesn't just sit there, it widens with every single statement you mail. Madoff's genius wasn't inventing this. Charles Ponzi did that a century ago and got caught inside a year. Madoff's genius was making it dignified, wrapping the oldest con in the world in the most trusted name on Wall Street, and then running it not for months, but for decades. Which left him one problem to solve every single day. The trades had to look real. Because sophisticated investors don't just take your word for it. They get statements, trade confirmations, pages of them. This stock, bought on this day at this price, these options sold on that one. Madoff's clients received detailed records showing exactly how the split strike strategy was supposedly performing, trade by trade, month after month. Hell, there was just one place all of it came from, not the stock market, a room. On the 17th floor of a Manhattan office tower, walled off from Madoff's legitimate trading business on the floors above, a small, loyal team ran the entire fiction. Led by a lieutenant named Frank DiPascali, they manufactured the trades after the fact. They'd pick prices out of the historical record, choose days when a given stock had done what they needed it to do, and print confirmations for trades that had already happened, in a past they'd selected to hit a return decided in advance. The statements were flawless. The prices were accurate. The math added up perfectly, and every trade on them was a work of fiction. And here is the tell that should have ended the whole thing years early. To run the split strike strategy on the tens of billions Madoff claimed to manage, he'd have had to buy and sell an enormous volume of S&P index options constantly. And when analysts finally did the arithmetic, they found something staggering. The number of options Madoff would have needed to trade was larger than the entire market for them. There were not enough of those options in existence anywhere on Earth for him to have done what he said he was doing. The trades didn't just go unverified. They could not have been real, and the records prove it, because in the clearinghouses where those trades were supposed to settle, there were no trades at all. So how does one man on one floor grow a lie into $64 billion? He didn't do it alone, and he didn't do it by knocking on doors. He did it through feeder funds. A feeder fund is exactly what it sounds like. A firm raises money from thousands of investors, pools it, and feeds it into someone else's strategy, collecting a comfortable fee for the service. And a whole industry of them grew up around Bernie Madoff, each one funneling other people's fortunes into his black box. The biggest was the Fairfield Greenwich Group, whose main Madoff fund alone carried billions in exposure, by some accounts more than $7 billion riding on him. There was Tremont, Kinggate, the Spanish bank Santander, through its optimal funds, Access International in France, Ascot Partners, run by the financier Ezra Merkin, which quietly steered money from charities and universities straight into Madoff. And here is the ugly brilliance of it. The feeder funds were paid handsomely to gather the money, but most of them were not looking too hard at where it went. Their fees depended on Bernie staying in business. And when your income depends on not asking a question, you get very good at not asking it. So the money came, and it came from everywhere. Jewish charities and foundations that trusted him as one of their own, hospitals, university endowments, European private banks, retirees who had handed over everything they had. Some of them didn't even know they were invested with Madoff at all. Their feeder fund had never once said his name. Thousands of people on multiple continents all pouring into a single 17th floor fiction. And exactly one outsider looked at that smooth line and said out loud that it was a fraud. His name was Harry Markopoulos, a numbers guy, a derivatives expert working for a rival firm up in Boston. In 1999, his bosses handed him a challenge. Madoff is putting up these steady returns, they said. Figure out how so we can offer the same thing. So Markopoulos sat down with Madoff's numbers, and in his own words, it took him about 5 minutes to know it was a fraud and another 4 hours to prove it mathematically. The returns were impossible. The strategy couldn't produce them. The options Madoff claimed to trade didn't exist in the quantities the strategy required. There were only two possibilities, Markopoulos concluded, and both were crimes. Either Madoff was illegally trading ahead of his brokerage customers, or, far more likely, the whole thing was a Ponzi scheme. So he did the responsible thing. He took it to the one agency whose entire job is catching exactly this. In 2000, Markopoulos brought his analysis to the Securities and Exchange Commission. Nothing happened. He came back in 2001. Nothing. In 2005, he submitted a detailed memo with a title that left no room for confusion. The world's largest hedge fund is a fraud, laying out dozens of red flags and effectively begging them to do one thing: subpoena Madoff's trading records, because the records would show the trades didn't exist. He warned them yet again in 2007. Markopoulos was so frightened by what he'd found, so aware of how much money and power was tangled up in it, that he genuinely feared for his life. He worried that Madoff or someone protecting the scheme might have him killed. And the SEC, which examined Madoff's firm more than once, never once pulled the single thread that would have unraveled all of it. They never demanded proof the trades were real. They had the map. They just never dug. So what finally killed a fraud that had survived 30 years in a federal regulator? The one thing a Ponzi cannot survive: everybody wanting their money back at once. Remember the engine. It only breathes as long as more money flows in than flows out. Through 2008, that balance began to tip, and then the financial crisis hit, and it inverted completely. As markets crashed that autumn, Madoff's investors, many of them bleeding losses everywhere else, did the natural thing. They turned to the one account that was, supposedly still holding steady, and they asked to withdraw. Not fake profits, their actual principal. Banks needed cash. Feeder funds needed to cover their own investors' redemptions. And the requests piled up, faster and faster. By the first days of December 2008, investors were asking Madoff to return something on the order of $7 billion. He didn't have it. He had never had it. Against billions in withdrawal requests, the account that was supposed to hold tens of billions of dollars in securities held, at the end, a few $100 million in real cash. The math that had been hidden for 3 decades became, suddenly, brutally simple. The new money coming in could no longer cover the old money going out. Madoff scrambled. He called in favors. He tried to raise fresh money from the loyal and the desperate. He even planned to hand out the last $170-odd million in the firm as early bonuses to family, to favored employees, carving up the final scraps before the end. Sure, but there was no plug big enough for a 30-year hole. For the first time in his life, Bernie Madoff had run out of other people's money. So he stopped running. On the 10th of December 2008, Bernie Madoff asked his 2 sons, Mark and Andrew, both of whom worked in the legitimate trading side of the firm, to come to his Manhattan apartment. And there he told them the truth. The investment business, he said, was all just one big lie. A giant Ponzi scheme. He was finished. He had maybe a few $100 million left, and the losses, he told them, would come to something like $50 billion. Understand the weight of that moment. By every account that followed, Mark and Andrew Madoff had spent their entire careers believing in their father and had no idea. And the 2 of them, that same night, made a decision most of us like to believe we'd make, and almost none of us are ever tested on. They called a lawyer, and they turned their father in. The next morning on December 11th, 2008, FBI agents arrived at Madoff's apartment. One of them told him they were there to find out whether there was an innocent explanation. Madoff looked at him and said, "There is no innocent explanation." He was arrested that day. The number attached to the fraud in the first headlines was staggering. $50 billion, then higher. And for a country already reeling from a financial collapse, Bernie Madoff instantly became the face of everything that had gone rotten. The trusted man, the chairman, the pillar. All of it a front for the oldest con there is. And now the bill came due, not just in dollars, in lives. So let's open the ledger. Start with the number everyone quotes, $64.8 billion. That was the grand total showing on customer statements in November 2008. The fictional value of every account added up, but most of that was profit that never existed. Inc. The real wound is the principal, the actual money that real people actually handed over and lost. The court-appointed trustee, Irving Picard, put that figure at around $17.5 billion. The Justice Department, counting somewhat differently, has cited roughly $19 billion. Either way, close to $20 billion of real savings gone. And then something almost unheard of in a fraud this size happened. A great deal of it came back. Picard spent more than a decade hunting the money, not the fake profits, but the real cash, much of it sitting with the net winners, the investors who had pulled out far more than they'd ever put in. His single largest recovery was staggering. The estate of one investor, Jeffrey Pacauer, settled for $7.2 billion, the biggest single forfeiture in the history of the United States Justice Department. And J.P. Morgan Chase, Madoff's own bank, paid more than $2.5 billion for failing to flag years of suspicious activity flowing through his account. All told, the recovery effort has clawed back more than $14 billion, well over 70 cents on every dollar of real principal, one of the most successful fraud recoveries ever mounted. For the small investors and charities who were wiped out, that mattered enormously. But no clawback could ever return the $64 billion that was never real. You cannot recover a number that was only ever ink. And for some of the people who believed it, the loss was never measured in money at all. Because when the number on the statement is your entire life savings and it goes to zero overnight, the fall is not abstract. 2 weeks after the arrest, René Thierry Magon de la Ville Huchet, a French financier who had funneled well over $1 billion of his clients and his own family's money to Madoff, was found dead in his New York office. He had taken his own life. He left word that he felt responsible and could not live with what his investors had lost. He was not the last. A retired British soldier who lost his family's savings through a Madoff feeder took his own life weeks later. And 2 years to the day after his father's arrest, Mark Madoff, the son who had turned him in, hanged himself in his own apartment, his young child asleep in the next room. The fraud kept killing long after the confession. And what of the man who tried to stop it? In February 2009, Harry Markopolos sat down in front of Congress and told them, on the record, that he had handed the SEC this fraud, gift-wrapped, again and again, for years and been ignored every single time. He was right, and now everyone knew it. The SEC's own internal watchdog confirmed it in a brutal report. The agency had received credible, specific warnings for over a decade. It had investigated Madoff more than once, and it had simply failed, through incompetence, its investigators concluded, not corruption, to ever take the one step that would have exposed him, checking whether his trades were real. The one man who did the math had been treated like a crank, and the fraud he described in writing years early was exactly the fraud that happened. As for Bernie Madoff, on March 12, 2009, he pleaded guilty to 11 federal felonies. No plea deal. He stood up in a courtroom and admitted the whole thing. On June 29, 2009, a federal judge sentenced him to 150 years in prison, the maximum and many lifetimes beyond his own. The judge called the crimes extraordinarily evil and said the sentence had to stand for something, for the retirees, the charities, the trusting, the ruined. Bernie Madoff died in a federal prison hospital in April 2021 at 82 years old. He never got out. And here's what he leaves behind in the ledger. Every investor who trusted him was looking at the very same thing, a statement, a confident, detailed, official-looking piece of paper that said their money was safe and quietly growing. And almost every one of them made the identical mistake. They trusted the statement. They never asked to see the trades behind it. One man did. Harry Markopolos looked at the same smooth line everyone else found so comforting, and he saw the impossibility hidden inside it. And when he went looking for the trades, there weren't any. That single act of verification was true and complete years before the collapse. The tragedy is that the people whose job it was to listen didn't. That's the lesson of the 17th floor, and it hasn't aged a day. A statement is only as real as the trades behind it, and a return you cannot verify is just a story someone is telling you. Every case in this ledger ends the same way. Someone finally asked to see the trades. If you want the next case file the moment it opens, subscribe. The Con Ledger, case number 3, closed.